Welcome, everyone. Today, we are looking at Topic 7 in your SS3 accounting series, Interpretation of Accounts. This is also called ratio analysis. Ratios are used to analyze and interpret financial statements. They show the relationship between different figures in the financial statements. Ratios are used to assess the performance, liquidity, and solvency of a business. This topic is frequently tested in your final examinations. You must understand the different types of ratios and how to calculate them. Pay close attention. Let us begin. First, let me explain what ratio analysis is. Ratio analysis is the process of analyzing financial statements using ratios. Ratios are mathematical relationships between different figures in the financial statements. They are used to assess the performance of a business. They are used to compare the performance of different businesses. They are used to compare the performance of a business over time. Ratios are calculated from the financial statements. The financial statements include the balance sheet and the profit and loss account. Understanding ratio analysis is essential for interpreting financial statements. This is a key concept. Now let me explain the purpose of ratio analysis. Ratio analysis serves several important purposes. The first purpose is to assess performance. It shows how well the business is performing. The second purpose is to assess liquidity. It shows whether the business has enough cash to meet its obligations. The third purpose is to assess solvency. It shows whether the business can meet its long-term obligations. The fourth purpose is to assess efficiency. It shows how efficiently the business is using its resources. The fifth purpose is to assess profitability. It shows how profitable the business is. The sixth purpose is to assist in decision-making. It provides information for management. Understanding the purpose of ratio analysis is essential for understanding why ratios are calculated. This is frequently tested. Now, let me explain the classification of ratios. Ratios are classified into different categories. The first category is profitability ratios. These ratios assess the profitability of the business. Examples include gross profit margin, net profit margin, and return on capital employed. The second category is liquidity ratios. These ratios assess the liquidity of the business. Examples include current ratio and quick ratio. The third category is efficiency ratios. These ratios assess the efficiency of the business. Examples include stock turnover ratio and debtor collection period. The fourth category is solvency ratios. These ratios assess the solvency of the business. Examples include debt to equity ratio and interest cover ratio. Understanding the classification of ratios is essential for understanding ratio analysis. This is frequently tested. Now let me explain profitability ratios. Profitability ratios assess the profitability of the business. The first ratio is the gross profit margin. This is calculated as gross profit divided by sales multiplied by 100. It shows the percentage of sales that is gross profit. The second ratio is the net profit margin. This is calculated as net profit divided by sales multiplied by 100. It shows the percentage of sales that is net profit. The third ratio is the return on capital employed. This is calculated as net profit divided by capital employed multiplied by 100. It shows the return on the capital invested in the business. Understanding profitability ratios is essential for assessing the profitability of a business. This is frequently tested. Now, let me explain liquidity ratios. Liquidity ratios assess the liquidity of the business. The first ratio is the current ratio. This is calculated as current assets divided by current liabilities. It shows whether the business has enough current assets to meet its current liabilities. A current ratio of 2:1 is considered acceptable. The second ratio is the quick ratio. This is calculated as current assets minus inventory divided by current liabilities. It is also called the acid test ratio. It shows whether the business has enough quick assets to meet its current liabilities. A quick ratio of 1:1 is considered acceptable. Understanding liquidity ratios is essential for assessing the liquidity of a business. This is frequently tested. Now, let me explain efficiency ratios. Efficiency ratios assess the efficiency of the business. The first ratio is the stock turnover ratio. This is calculated as cost of goods sold divided by average inventory. It shows how quickly the business is selling its stock. The second ratio is the debtor collection period. This is calculated as debtors divided by credit sales multiplied by 365. It shows how long it takes for the business to collect money from debtors. The third ratio is the creditor payment period. This is calculated as creditors divided by credit purchases multiplied by 365. It shows how long it takes for the business to pay its creditors. Understanding efficiency ratios is essential for assessing the efficiency of a business. This is frequently tested. Now let me explain solvency ratios. Solvency ratios assess the solvency of the business. The first ratio is the debt-to-equity ratio. This is calculated as total liabilities divided by owner's equity. It shows the proportion of debt to equity. The second ratio is the interest cover ratio. This is calculated as profit before interest and tax divided by interest. It shows whether the business can cover its interest payments. Understanding solvency ratios is essential for assessing the solvency of a business. This is frequently tested. Now let me explain the difference between profitability and liquidity. Profitability and liquidity are different. Profitability is the ability to make a profit. Liquidity is the ability to meet short-term obligations. A business can be profitable but not liquid. A business can be liquid but not profitable. Profitability is shown in the profit and loss account. Liquidity is shown in the balance sheet. Profitability is important for long-term survival. Liquidity is important for short-term survival. Understanding this difference is essential for interpreting financial statements. This is frequently tested. Now let me explain the importance of ratio analysis. Ratio analysis is important for several reasons. First, it assesses performance. It shows how well the business is performing. Second, it assesses liquidity. It shows whether the business has enough cash. Third, it assesses solvency. It shows whether the business can meet its long-term obligations. Fourth, it assesses efficiency. It shows how efficiently the business is using its resources. Fifth, it assists in decision-making. It provides information for management. Sixth, it assists in comparison. It allows for comparison over time and with other businesses. Understanding the importance of ratio analysis is essential for understanding why ratios are used. This is frequently tested. Now, let me explain the limitations of ratio analysis. Ratio analysis also has some limitations. The first limitation is that it is based on historical data. It does not show future performance. The second limitation is that it can be manipulated. The figures can be manipulated to show favorable ratios. The third limitation is that it is not standardized. Different businesses use different methods. The fourth limitation is that it does not consider external factors. It does not consider the economic environment. The fifth limitation is that it is not a substitute for judgment. It should be used with other information. Understanding the limitations of ratio analysis is essential for a balanced view. This is a key concept. Now let me give you sample exam questions to prepare you for your test. What is ratio analysis? Ratio analysis is the process of analyzing financial statements using ratios. State the purpose of ratio analysis: to assess performance, assess liquidity, assess solvency, assess efficiency, assess profitability, and assist in decision-making. State the classification of ratios: profitability ratios, liquidity ratios, efficiency ratios, and solvency ratios. What is the gross profit margin? Gross profit divided by sales multiplied by 100. What is the net profit margin? Net profit divided by sales multiplied by 100. What is the current ratio? Current assets divided by current liabilities. What is the quick ratio? Current assets minus inventory divided by current liabilities. What is the stock turnover ratio? Cost of goods sold divided by average inventory. What is the debt-to-equity ratio? Total liabilities divided by owner's equity. Explain the difference between profitability and liquidity. Profitability is the ability to make a profit. Liquidity is the ability to meet short-term obligations. Let me summarize everything we have covered today. Ratio analysis is the process of analyzing financial statements using ratios. Ratios are used to assess performance, liquidity, solvency, and efficiency. Profitability ratios assess profitability. Examples include gross profit margin and net profit margin. Liquidity ratios assess liquidity. Examples include current ratio and quick ratio. Efficiency ratios assess efficiency. Examples include stock turnover ratio and debtor collection period. Solvency ratios assess solvency. Examples include debt-to-equity ratio and interest cover ratio. Ratio analysis is important for decision-making and comparison. It has limitations. It is based on historical data and can be manipulated. Understanding ratio analysis is essential for interpreting financial statements. This is Topic 7 in your SS3 accounting series. Study it well. It is frequently tested in your final examinations. Well done.